Hello, so welcome to the latest ITPM Flash. Today I'm going to talk to you about US equities versus European equities and emerging market equities. Here we are on Liberation Day, the much anticipated day of reckoning when President Trump announces what he intends to do with reciprocal tariffs against the rest of the world. The economic backdrop is weak US personal real spending, stubbornly above Fed target inflation, and rising inflation expectations, indicating increased downside risk to the US economy. Is it our job to second guess exactly what the tariff announcements will contain? No. Is it our job to take a big directional punt on whether the US goes into recession or merely experiences a temporary growth slowdown? No. Do the uncertainties surrounding US policy making make trading and investing in the US a lot less attractive? Yes. So here's a chart of inflationary expectations. Inflation expectations are rising. Not surprising, given all of the talk of tariff increases and the upward move in commodity prices. But after 3 years of contraction, inflationary expectations are rebounding. What this chart shows you is the Atlanta Fed Consumer Inflation Expectation Survey and the New York Fed Business Inflation Expectation Survey. Are commodities breaking out? Here's a chart of the CRB Commodities Index going back to the beginning of 2016. Just as a note, the weightings within that index are as follows: energy, 39%, agriculture, 41%, precious metals, 7%, base industrial metals, 13%. Most countries enter 2025 with low commodity inventories. As the cost of funding has risen, why would you hold capital in deadweight metals or barrels of oil? However, now, given a rapidly shifting geopolitical situation, keeping commodity inventories, especially for countries that have historically relied upon the US security umbrella, may have become an imperative. In addition, there is the tariff threat from the US. If you need copper, silver, Canadian oil, or whatever else in the US, it makes sense to buy and import it before tariffs take effect, which is what we've seen in Q1. Whatever the reason, since the beginning of November, the CRB Commodity Index is up 10% and is making new decade highs. The US federal budget. US budget deficits are still coming in worse than expected. It is still too early to properly assess the impact of the DOGE and their attempt to rein in US government spending. For now, the budget deficit continues to make new highs. So why the relative US equity market underperformance now? Irrespective of what materializes later today, few global traders saw this year's sell-off in US equities and the simultaneous rally in European and other international equities coming. The MSCI US Mid and Large Cap Index is down 4% in 2025, whilst the same index for Europe is up 12% in US dollar terms. This trend may only be a few months old, but for now, it is reversing the sustained US outperformance that has occurred for at least a decade. This shift is mostly explained by a narrowing valuation gap rather than any great change in earnings expectations. The questions are, what explains the reversal, and will it prove more than a temporary shift or become a much bigger reversal of fortune? Since 2016, the increase in US equity valuations relative to those in Europe, measured by the 12-month forward price-to-earnings ratio, can be divided into 3 distinct phases. From 2016 to 2021, US and European equity valuations diverged, but remained within their post-2003 range. Between 2022 and 2024, we saw the US outperformance over Europe melt up as the US equity market valuations rocketed. The third and last phase is only 3 months old and has seen a reversal of the US's valuation advantage over Europe. As stated, this has nothing to do with earnings expectations, but is down to relative valuations reversing course. Why the move towards mean reversion now? 3 key factors can explain the the US exceptionalism versus European pessimism since 2016. 1. US energy independence. 2. The very different fiscal regimes. 3. Deflation and pessimism in Europe. On to number 1. The US shale oil and gas extraction revolution transformed the US from being an oil importer to achieving low-cost energy independence. On the other side, European energy firms faced a tighter regulatory environment for fossil fuels and were compelled to expand into higher risk and lower margin renewable energies. 2. The fiscal differences. Between 2016 and 2024, the US budget deficit continually widened, even when the US economy was growing. Europe, on the other hand, focused on fiscal consolidation. After the 2008 global financial crisis and the 2011-12 Eurozone debt crisis, Southern European economies signed up to tough fiscal rules imposed by Brussels. At the same time, Germany religiously enforced its constitutional debt brake. The European Union's fiscal straitjacket was temporarily relaxed in 2020 to 2023 to deal with COVID and the Russia-induced energy crisis. But fiscal consolidation was firmly back on the agenda by late 2023. That has now begun to change. Significant change is happening in Europe. Most important is Germany's U-turn on fiscal policy. So in summary, for point number 2, European fiscal policy is evolving to more closely resemble US fiscal policy. And number 3, deflation pessimism. European banks, for example, were in a value trap for a long time, combined with skepticism about a reflationary shift in Europe. This clearly was a symptom of the European growth pessimism malaise. This led to a derating of European financials against their historical record and relative to their US competitors. Now, with 5 years of solid performance under the belt and increasing evidence of Europe shifting its macroeconomic regime, the attitude of investors to European financials has properly changed this year. That's a key development for European equities as a whole. The narrowing of the valuation gap between US and European equities seen this year actually makes sense. 2 out of the 3 factors that drove the widening after 2016, US fiscal expansion and European pessimism and skepticism towards European value stocks, are fading. For example, just look at the rampant bull market in European defence stocks. As a result, traders might expect the gap to close further. It means that European equities could continue to outperform US equities. Emerging markets. So lastly, I'd like to talk about them. The emerging markets ETF, EEM, is up 6 to 7% in US dollar terms, whilst the US stock market is down around 3.5%. The last time we saw emerging markets outperform the US stock market over the first quarter of the year was 2018, which of course was a long time ago. There's a wide dispersion as well of returns amongst the various countries that make up EM. So for example, China and Brazil have done very well. On the other hand, India and Taiwan, which are also decent-sized weightings in the EEM, have disappointed in both relative terms and with negative returns. The weaker US dollar has also been one of the main reasons for emerging market outperformance. Chinese stocks have been rallying mainly because they were underowned and oversold, plus we now have increasingly positive policy tailwinds in place, helping to generate the re-rating of Chinese stocks. Brazil, which has been an underperformer for quite some time, has also enjoyed a pretty healthy rally, probably down to the Milei effect. Javier Milei's economic success in Argentina has changed the political equation in Latin America, and there are Brazilian elections to come next year. I think it's probably best to selectively pick up exposure to emerging markets, particularly the ones that have long-term underperformed or are not as directly exposed to the threat of US tariffs. China has reduced its export tendency on the US since the first Trump presidency. The earnings re-rating story there isn't going to be derailed by the tariffs that have already been imposed or any other future tariffs that are likely to be imposed. Idiosyncratic narratives, like Brazil, may also have more to run to the upside on a relative basis compared to the US. Javier Milei's economic success in Argentina has changed the political equation, as I say. In the next 18 months, several big Latin American countries will have elections: Chile, Peru, Colombia, and of course Brazil. The probability of a big shift to the right is increasing. If so, local investors are likely to repatriate capital, and the year-to-date rally in Latin American currencies, bonds, especially in Brazil, and equities could really have legs. So, putting it all together, the global investment landscape is changing fast. A few months ago, the perception was that the only place to deploy capital safely was in a handful of US mega-cap tech names and gold. Today, there's a decent bull case for Latin American debt and equities, Chinese equities, as well as European equities. The investment trading landscape, irrespective of tonight's tariff announcements, has shifted and is looking far more interesting than just a few months ago. Thank you for watching, and see you next time.